go from there. All right. And with that, I wanted to welcome you to the State of Funding panel in 2022. I've got three amazing guests with me today, all with different experiences with funding, and I'll let them introduce themselves. First of all, starting with Yumatan from Versa Ventures. How are you?
Hey, I'm great. My name is Yumatan. I've been in the venture capital space for 8 or so years. Verstro Ventures is the most important thing about us is that we're part of a much larger publicly traded company called Constellation Software, who is known for uh, acquiring software businesses all over the world. Verstro is investing in external startups, looking to make investments in B2B vertically focused software companies, anywhere from $500,000 to a few $1 million per deal.
Amazing. Thank you very much. And next on the list is Dara from Swoop Funding. How you doing, Dara?
Hey, Greg, thanks for inviting me on. So my name's Dara Burke. I'm leading the Canadian team for Swoop Funding. We're a marketplace for business financing products. So we help connect SMEs with products across debt, loans, grants, any type of government funding, but also savings and help them kind of realize savings in their business. We launched the business in Ireland and the UK in 2018, and we've since grown into Australia and most recently Canada. We're sector agnostic, so we work with all types of businesses, from startup through to kind of expansion and growth phases across all product verticals. We also work with a lot of accountants, brokers, and different advisors that work with small businesses to help them get their clients funding. So that's us.
Fantastic. And Alex from Equivesto.
Hey, Craig. It's great to be here. I'm Alex Morsink, co-founder and managing director of Equivesto. Equivesto is a Canadian equity crowdfunding platform and exempt market dealer, and we can help small and medium-sized businesses raise up to 1.5 million in capital through the participation and investment of their extended community and the general public.
And we've had a lot of success stories here. I've interviewed a few people who've been on the Startup Talk podcast, have had successful raises on Equivesto. If people want to find that out, check that out at startuptalk.ca. Let's get right into it, and we'll start it off with Yumatan. You know, when COVID hit, VCs changed what they were looking for, and every startup had to develop a plan for COVID. You know, funds froze for a while, then they kind of loosened up, but they redirected their portfolios. Here we are now, over 600 days into COVID. Are investors looking for a COVID exit strategy from startups? You know, how does your business model change when we open up again versus what is your plan for the shutdown like it was? Or is there a different view of the pandemic and what's happening as a startup investing in 2022?
Yeah, I would have thought that this whole situation would make people a bit more conservative. And it's done the exact opposite in the VC community. People are investing more money with higher valuations in companies with less traction, which is something that surprised me at the beginning of this. I thought people would take a step back and reevaluate how they look at companies, but it hasn't quite happened yet or at all. One thing that I've seen is that most companies, unless they're directly impacted by closures, like in the restaurant space, for example, COVID has become less of a talking point. I used to come up in every conversation, you know, a year in, but the last several months, it rarely comes up. I think most people want to move on, and they have for the most part.
Great. I'm just wondering if, you know, startups like Peloton or delivery startups, or if there's some change that they have to start thinking about as things are, you know, a little more unstable and their business might have to now adjust slightly, where people are starting to do more real life events, or hopefully we'll see. Uh, Alex, you know, the equity crowdfunding rules changed in Canada in 2021. Can you tell us a little bit about the biggest changes and how startups can take advantage of them in 2022?
Certainly. Yeah, we were really proud to be able to work with other members of the community and the securities regulators in Canada to actually change and expand the equity crowdfunding rules in Canada. And finally, Canada has rules kind of on par to the rules that we've seen in the US, the UK, other jurisdictions that really have had a lot of success with equity crowdfunding. I think that the major changes would be the maximum amount that a member of the general public when getting advice from an EMD like us, can invest in a company has gone up from $2,500 to $10,000. And the maximum amount a company can raise over a 12-month period is up from 500,000 to 1.5 million. And there's no longer any limit to the number of campaigns a company can run on an annual basis. So really the amount that individual investors can invest in your business has increased, and the amount that you can raise overall from the general public and everything has grown. You can still continue to raise any amount you'd like from accredited investors or angel investors alongside your crowdfunding campaign, but really the participation of the crowd itself has really expanded with this regulation change, but there hasn't been any increase in the amount of reporting work or anything like that that has to be done. So it's really been a great step to bring Canada sort of in line with the rest of sort of the sort of first world countries with how they're managing equity crowdfunding.
Dara, you work with all types of funding for businesses, as you mentioned. Are there more interest in different types of capital sources as we head into 2022? And if so, which ones? Oh, you're muted.
Sorry, I had myself on mute. Yeah, so I think coming into 2022, like some of the macro trends have influenced what we're seeing on our platform anyway, and what we're seeing in our business community. I think one of the obvious ones that's getting a lot of attention at the moment is the shipping crisis and how that's playing out in supply chains. And that's transcended a lot of different sectors. So we do have a lot of e-commerce businesses that come onto our platform. And one of the sort of trends that I've seen in the products that they're going for is in relation to inventory financing, working capital financing. So they're, traditional inventory cycles getting a bit longer. So the time it takes them to convert stock into finished goods and send it out takes a little bit longer now. That's challenged a lot of very strong businesses that are, have good revenue numbers, etc. So one thing I've seen is an increased demand for working capital products. That could be financing purchase orders from customers, which again is very popular with early stage businesses that might not have a lot of cash at hand to produce. Lines of credit, other types of working capital facilities, inventory financing, trade financing if they're buying stock in another jurisdiction outside of Canada. I think all of those working capital type facilities we've seen a lot of demand for. I think alongside that, what's been consistent, so not just a spike after 2022, is some of the innovation grants, so the SHRED, the IRAP. We've seen a lot of not just applications into those programs, but also financing. So companies are now starting to think, right, we're creating IP, we're doing something different, we're getting an application in, but straight away we want to finance it, do more shreddable activities, make it bigger, or accelerate some of those projects that they're taking on. I think another kind of key one we've noticed, particularly in the last couple of weeks since we started the new year, has been around equipment. So a lot of businesses looking to either refinance equipment or purchase and scale up and buy new equipment. So that could be leasing, which has tax benefits for business, or actually getting a loan out to buy a new piece of equipment. And then I think finally, new supports related to the pandemic. So as the landscape's changing, and I think Yumatan had mentioned certain sectors that are more hit than others at the moment, like restaurants. Obviously, there are some supports. A lot of people would say they don't go far enough, but there are some supports coming online for those businesses, usually at a provincial level, but also federally administered programs like HASCAP, for example, has been extended. So there's activity still on our platform related to the pandemic, specific to funding that we're seeing changing coming into 2022.
That's great. Thanks. Matan, can you describe the startup funding cycle and where VCs fit into it?
Sure. So this changes constantly because the taxonomy used in the VC space is like, what is a seed investment versus Series A? But essentially, companies that, let's call it pre-revenue, they typically need to go to an incubator, accelerator, or go to angel investors to raise capital, because those are the ones that are willing to take on that risk. They invest in a lot of companies, a small amount in a lot of companies. So from a risk point of view, it makes sense for them to do that. Then from there, once they start developing the product, get some traction with customers, maybe an early pilot or proof of concept, that's kind of the seed stage where they're trying to validate their product market fit, they're putting together their core team. And that's when VCs may start getting involved, but more often than not, just still dealing with angel investors. VCs are still slowly moving to later stage kind of funding, which is kind of this, what they're calling now post-seed. So a company that's found product market fit, maybe has a few $100,000 in recurring revenue or revenues from their target customers. And that's where VCs really start to get involved. The reason they get involved only at this stage typically is because it's very expensive to make venture investments. It takes a lot of time. And you can't do that when you're only investing a few $100,000. It kind of has to make sense financially. You have to be able to deploy a lot of capital. And you can't do that if you're spending, 2 months to do a few $100,000 investment. So it only really starts to make sense when you're investing $1 million plus as a venture capitalist. Now, when a company's found product market fit and they are ready to pour gasoline on the fire, hire salespeople, start to professionalize their different functional areas like marketing and sales and product development and all that, that's called Series A. And that's where the company needs to take their, call it $1 million revenue and turn it to $5 or $6 million revenue. And then once they've done that successfully, which happens very rarely, then you're talking Series B level, which is anywhere from $5 to $20 million in revenue. Again, this all changes and everyone has their own definitions. This is kind of what I've seen. And that's and from Series B, you're talking about a whole different set of investors that look for slightly different things. You're talking about a more professional company. The metrics and everything have to be tied down. Your team has to be professional and ready. And then you're talking about raising 20, 30, 50, $100 million. And then you're going to Series C, and then you can go Series D and E and all that stuff. But I think for the purposes of, so to speak, startups and early stage companies, those 3 stages, seed, Series A, and Series B, that's kind of the general progression, I would say.
Thank you for that. And those numbers and ranges change, obviously. I think I asked you this question 3 years ago, and those numbers were smaller. And if you're dealing with a U.S. VC firm, they might be bigger numbers, and dealing with a Canadian VC firm. So, yeah, bear with those numbers. But that was great info. And Alex, this leads me into you. When should a startup consider equity crowdfunding?
It's a great question, Craig. And yeah, I appreciate you mentioning the difference, depending on country when it comes to, the labels and the amounts for each round. Because I know in Canada, basically you can just take a smaller and just a small piece of the same amount, the equivalent amount in the US, and that's like your seed round. But in terms of, when is the right time to consider equity crowdfunding? I think for a company considering equity crowdfunding, you want to think about what the main driver for a successful campaign is going to be. And that's going to be the engagement and the excitement of your extended community and the ability to spread and share that message. So either you already have a strong community around your business, and so you could be a lot earlier stage, but you have this strong community and you want to engage that community. Or if you don't have a strong community, but you're later in the stage of your business and you're looking to really start deploying dollars you've already raised on a sort of wider spread marketing campaign, and you want to have those dollars sort of do double duty, and you're building your brand awareness, then you can have that work you're doing, building the brand awareness, also bring you potential investors. The key piece is that community engagement. And so making sure, that you have a method to attract or build a community, or to sort of activate a community that you already have. For Equivesto, there are some minimum requirements, which are that you have a minimum viable product or some sort of demonstrable sales or revenues from operating your business. So if you're a startup, you'll need, an MVP for your product. But if you're a restaurant, you don't need an MVP. You'd want to sort of say, okay, we've got the lease, we've hired the team, we're opening the restaurant soon type situation.
Fantastic. Thanks for that. Dara, you hit on this earlier about different funding programs. In 2021, the government funding was all over the place, with many programs being oversubscribed days after opening and some programs being closed altogether. Are the programs opening up again that founders should be aware of?
Yeah, it is a tough landscape to keep track of and stay on top of at the best of times. So I think COVID really kind of test that as well. I mean, even recently, when the most recent set of restrictions came down in most parts of Canada, the restrictions came first and the funding supports came after, and there was a period in the middle where, you know, businesses, chambers of commerce, everybody was kind of stressed, and, you know, rightfully so. Some businesses were really kind of holding on by a hair. So yeah, to answer your question, coming into this year, I think some of the bigger ones that were extended was the HAS cap, which again might not be relevant for some startups in the audience because you're typically up and running and you're taking advantage of SEBA and those type of programs to unlock that. I think if you were a business that you can demonstrate was negatively impacted by COVID, there are cost rebate programs here in Ontario. There's tax deferrals available on most provincial taxes. There's small business relief grants up to 5K, most or 10K in some of the bigger SMEs, 3 or 4K probably in some of the smaller businesses. British Columbia has gone a little bit further than that on that particular program. I think the SEBA loan was extended, which was another big change. So that's now repayable end of 2023, I think, which was definitely a relief for a lot of businesses because they're preparing to get the working capital in order to meet those repayments. But I think other than those chopping and changing in the recent past, there are some other programs that are mainstays that I think are important to be aware of for a lot of startups, particularly when you're getting to that stage where you are looking to bring on an extra resource, first couple of critical hires. Always think about what government funding sources are available to support that. You know, there's a lot of businesses that we deal with that are able to fund their first couple of hires to a really, really high percent through, you know, innovation assistance program, ventures for Canada, digital skills for youth. So there's kind of an array of programs that are available, and it's important to really kind of have a look at them and take the time to research them or speak to someone who's in the know. Most people will have a conversation for free. There's grant agencies out there. So there's a lot of help available when you're taking on your first couple of people. I think for startups, again, you know, there's a lot of good stuff that the Futurepreneur and BDC do on the debt side as well. So again, some businesses might be afraid to take on debt, which is understandable, of course. But if I think about the Futurepreneur program, there's interest-only payments for an extended period of time, which does give you a little bit of leeway to use the capital and deploy it and to invest in your operations. That can be topped up with some BDC funding as well to bring it up to maybe 60K, which again can be a really big resource when you're getting going. CSBFL, again, it's debt, but again, it's up to a 10-year term through most of the banks and the credit unions, and it's relatively cheap debt. So again, worth exploring that. I think one of the ones that I noticed came online again this month was the can export one. So if you're planning to sell to any customers outside of Canada, which is often the case right off the bat for a lot of Canadian businesses, particularly south of the border, you know, I think from the 11th of January, applications opened for new export programs. So that's something to be cognizant of up to 50K up for grabs there. Shred and IRAP are mainstays for anyone producing anything that's kind of innovative or digital or anything to do with IP. You know, very lucrative. And as I mentioned earlier, when businesses are looking at that application, I think it's also important to consider financing options as well to accelerate that cash flow and to look at expanding it and growing your projects. So yeah, there is a huge amount going on. It's a really wide landscape. I mean, on our platform, we've got over 200 government funding programs, and it really does change by the week. So it is a challenging one to keep on top of, but there's a lot of resources out there for startups. So I think in particular, when you're looking to take on staff or when you're looking to invest in new projects and build technology, there are supports out there that can be really helpful.
There are a ton of stuff on your website, and I know the landscape changes a lot, and we're going to get to a few more questions about the types of things that you do and when people should reach out. Yumatan, what types of investment does Verstro Ventures look for?
We look for companies that we can add value to beyond capital, and also companies that can teach us, and we can apply to the 1,000 or so other businesses within Constellation. So practically that means B2B vertically focused software companies, because that's a specialty of our parent company, that have some unique technology or approach or process or trade secrets that they're bringing to the market. Of course, that also means we're looking for companies that have great teams, they have traction, they're growing, they're in markets that are thriving, they have thought through their product and their value proposition, all the things that every other investor looks for. But what's unique about us is that we look for specifically B2B, vertically focused software businesses. Vertical means that the company's focused on a particular industry or subset of customers within an industry. And our perspective is that when a company does that, they can build a product that is so tailor-made for those specific customers that it creates a natural barrier to entry. And they understand their customers very well. So that's more specifically, we look for companies that have at least a couple $100,000 in recurring revenues from their target customer as well.
Good information. Alex, why aren't more people taking advantage of equity crowdfunding?
It's a good question. Equity crowdfunding, as you mentioned about the rule change in your previous question, equity crowdfunding rules only recently came into effect in Canada. If we look at sort of equity crowdfunding and what's been kind of barriers to success before, you really need to have stable, usable rules, sort of protecting the industry, but also allowing companies and investors to kind of meet in the middle and make the transaction work for them. So the rules that were in Canada before were very individual on a per province basis, and many of them weren't really usable. And so there hasn't really been that opportunity for businesses to take advantage of it in reality, because the costs of using some of the older methods were just larger than even the capital you could potentially raise. If we look to the US, once they were established with rules that sort of made sense for them, they were able to grow and expand with the number of companies and investors taking advantage sort of more rapidly. Same with the UK. So in Canada, we're just getting to that point with the rules making sense. And then the second piece is awareness. Because the rules sort of weren't allowing a lot to take place, you weren't seeing a lot of companies raising successfully, so no one would really be talking about it. You'd hear about it, in companies being successful in the US, in the UK, around the world, but never really as many opportunities in Canada. But really that's starting to change now. So as more and more people either raise capital or invest in a company and sort of see how it works, just word of mouth and market awareness will grow more in Canada.
Yeah, I agree. It's going to grow. It is growing, and it's just around awareness and standardization.
Yeah, it's just to add on that the number of equity crowdfunding platforms in Canada is so small. There's really us and maybe one or two others in the space, that when you actually look at okay, what is the current size of the market in Canada, and you try to base that on the amount of money raised through equity crowdfunding, for example, in the previous year, really all I have to do is call up, our two competitors and ask them how much they raised, and that's the size of the market because it's so new. But if you look at the potential and the number of investors in Canada, the number of people living here who have some money that would be interested in investing, as well as the number of small and medium-sized businesses. There's 1.2 million small and medium-sized companies in Canada, the last time I checked StatsCan. And so there's such a huge number of businesses here that could potentially take advantage of this, but it's just the rules weren't in place.
Tara, I talk to all sorts of startups who some, are completely lost when it comes to funding. Others says, no, don't worry, I got it covered. So my first question is, how often do you see companies leaving money on the table? And when, in that range of I've got it covered to I'm completely lost, when should startups reach out to Swoop?
Yeah, it's a good question. I think first of all, the simple answer is, almost right away, because whether it's a startup loan, whether it's trying to get your business plan in order so you can apply for grants, whether it's trying to get a pitch deck in a reasonably good shape so you can maybe get in front of VCs, or it's looking for debt, or looking for equity financing when you're a little bit further down the road. Swoop has and can serve businesses right through their life cycle. So we do have a product offering at every stage. So to answer your first question, we're really able to create value for businesses at the start. To answer your second question about how often do we see businesses leave cash on the table, all the time. And I think to kind of echo what Alex was saying on crowdfunding and education and awareness and visibility, sometimes small business owners and startup business owners don't have the time to invest in just figuring out all the best financing options out there. And that might be compounded by the fact that they're not finance people from the outset. Obviously, you acquire certain skills as you go on and build a business, but from the outset, they're not an accountant. They're not going to hire an accountant as one of their first hires, and it may not just be a strategic priority, so it might be an afterthought. So having tools available and software available and different kind of marketplaces and platforms that they can leverage to try to save time, and in that way, I think is hugely beneficial. But yeah, the grant funding is a perfect example. I mean, businesses oftentimes don't have the time to pay attention to all the grants that are available. I think Canada is a great example because of how diverse and wide-reaching the grants landscape is. But huge amount of government funding often left on the table. We deal with businesses in the UK and in Ireland who don't even know how an R&D tax credit works. Same is the case here with the shred process in Canada. That's a really lucrative cash upfront program. It's the name is confusing. You don't get it as you don't deduct it off your profits. You actually get that cash upfront, and you can invest it in your business. So there's all of these government funding programs that often get ignored. Likewise, government guaranteed debt for startups. That's quite widely available in Canada. So you don't have to demonstrate that you have a really strong balance sheet with a perfect credit score or anything like that. That's debt you can access at a pretty cost-effective rate right off the bat. A lot of businesses would go without applying for that, because they're a little bit afraid of taking on debt, even when it can really benefit their business. So yeah, we at all stages we do see quite a lot being left on the table, in particular within grants and government funding.
Matan, what do you wish more founders understood before working on a term sheet and negotiating investment terms with yourself or with VCs?
It's a fantastic question, because I was also in that spot myself, and I made quite a few mistakes. The mistake I made is thinking that my company was worth more than it was, and I see a lot of people making that mistake, and it's harder for some founders to see that because we're in a quite frothy market. But I think it's important to point out people are investing in the future of your business and in the person and the team, especially in the early stages. It's really all about the team and the potential of what they're creating. The business itself isn't worth anything. It's losing money. If it's doing anything, it's losing money. And I think having a little bit of humility and realizing that this person or this group is taking a chance on you, and to negotiate, if someone's saying your business is worth $5 million when it's really worth less than zero because it's not generating any money, requires a bit of humility to take a step back and say, wow, someone just told me my team is worth $5 million because we're just here and we're showing great potential. Rather than saying, oh, well, I know some guy in Silicon Valley that went through Y Combinator and he got a $30 trillion investment. He only has less. It's like, I see that all the time, and those people we say no to right away. We don't deal with those kinds of people. Not that there isn't room to negotiate and to have a reasonable meeting of minds and to figure out a way to move forward. But sometimes, and it shows that it's a sign of maturity also. It's not an age thing, it's more of a maturity thing. Like if you recognize what I'm saying, you see that someone is investing in a company that's not worth anything, and they're telling you, I'm willing to give you $1 million or $500,000 or whatever it is, because we believe in you. And then that's an important thing for founders to realize, especially at the early stages, especially when it's the first time that they're doing it. And if that's the message someone takes away from tonight, please take away that message. For me, at least. Everyone else had great things too, but if that's one message I can give tonight, that should be it.
I'd love to jump on what you were just saying, Matan. Part of what we do and part of our support to companies who come to do equity crowdfunding on Equivesto or raise capital with Equivesto is help structure the deal, provide feedback on projections, but a lot of it is, advice, feedback, and structuring around the valuation itself. And so much of the industry and the information that's available to startups happens to be content created by Silicon Valley, which is one of the largest areas of startup funding. But if all you're doing is reading the Crunchbase daily email blast, it can really warp your understanding of like what's actually taking place in the industry. You know, what a seed round is in Canada is not what a seed round in the United States is. And looking at Silicon Valley and saying, okay, some dude who went to Stanford and is friends with Mark Zuckerberg and used to work at Google got with just a pitch deck, got this massive amount of money and this ridiculous valuation for his seed round, and that gets published in Crunchbase. And so you look at that and you say, my idea is better than this, and then you approach a VC or you approach someone and say, hey, I'm building this business. I think it's worth $30 million. But we're not going to start generating revenue until 6.5 years from now. And I don't have a clear business model, but it's in a space like there's a lot of noise coming out of Silicon Valley that can really kind of confuse founders, especially founders in Canada where, we're operating in a totally different environment. So I totally agree with what you're saying there.
Yeah, I want to add to what you're saying because that's a great point. It's their selection bias. So, if you're only looking at the companies that are in the news, those are the successful companies, right? And yeah. I see 500 to 1,000 deals a year, and I can see sometimes when a company gets funded, I know for a fact, like I know whatever you can see. Oh, this company started like a year ago, and they're getting a $10 million valuation, and then someone comes to you, oh, I've been in business for 3 years and I have more traction than them, and I'm in the same market. And you're not giving me a $10 million voucher. Like, you have to understand that the relevant information is not going to be the news articles. Why someone invested, what the deal looks like, and the specifics. All the details are not there. They're giving you like the highlight to generate eyeballs. They get eyeballs to look, and so they're going to put the most interesting thing. And yeah, there are a lot of outliers there which do get put in the news. So it's very important that before you're going to a VC or someone, get an advisor, talk to Craig. I know he knows the stuff. Go to Alex and go to Equity Crowdfunding, or get an advisor on your team that knows the space, knows what VCs are looking for, know how they approach businesses in your industry. It's so critical because if you show a lack of maturity, it makes, I know my job, I have to sift through many deals. And what I need to do very quickly is decide, can I invest more of my time with this team? And if they show serious lack of maturity, then it's less likely that I'll spend more time with them.
Totally. Everyone seems to feel like approaching, VCs. Every VC is the same. Every VC is looking for the same kind of deal. And there's no difference whether it's, a Canadian VC, a US VC, or even, industry split. People will send that one cold email to like 55 different VCs all at once. And for founders, I would really remind you, like, VCs are run by people, but the VC itself is fulfilling a specific mandate for its limited partners. Those limited partners have invested in that VC because the VC is promising to focus on a certain thing, whether the limited partners are individuals or corporates. And so, with Yumatan and your fund, you have a very specific mandate. And I'm sure it's very clear about that on your website. So do the research beforehand and match your business with the stage and the industry and the vertical that different VCs offer. It's a small world, and if you email blast 100 VCs all at once, the likelihood that some of them know each other and are going to say, hey, did you get this random email from the sky? And they'll say, oh yes, the likelihood is very high. So take your time, look into that, and check out Twitter. I'm not really a big Twitter guy, but Twitter in the VC space is very active. That's my top tip.
Yeah, Twitter, LinkedIn, a few social media things, depending on, I know even Snapchat for some people, for some investors, is reach out where the investors are. Like, if they're active on that channel, that's where to go. I did a session on cold emailing investors, cold outreach. You can find it on our YouTube channel somewhere. Take a look. It really gives advice on all this stuff, and take a little bit of time to customize each message, and the return on your investment of that is absolutely amazing. So we talked a little bit about, some businesses more affected by COVID than others. And we kind of hinted at, some trends that are happening. And I see, a rise in eco brands. I see in 2022. The Great Resignation, sorry, blanked there on the Great Resignation. So there's all these different trends that are happening that are going to affect the economic climate. What areas or trends are hot or will be heating up for investors in 2022? And I'm going to throw that over to you again, Matan, and see who else jumps in.
Yeah, it's interesting. I do think the last 2 years really changed things permanently for in a lot of industries. One couple of the areas that I see really getting hotter is kind of decentralizing finance. I don't mean decentralized finance like blockchain. I mean opening up the banking system much more so that consumers and people that have bank accounts actually can control their data much better. That's been happening for a few years, and I think it's gonna ramp up. The Visa trying to acquire Plaid is a part of that, but that was like the first salvo in a much longer trend that's going to be happening for the next several years. The other thing I see happening is digitizing logistics more. Logistics is a very old school business, and we see a lot of the weaknesses in the supply chains coming up now. We didn't notice the weaknesses before because everything went along pretty nicely, but there's a lot of the creaks and cracks in the logistics space coming up now, and it's not just that there's less shipping containers or less boats or people staying home because they're sick. There's a lot more problems in the logistics industry that you'll never see because you never have to deal with it. But we're seeing it now when you don't see things in the stores, or your furniture is going to take 3 months to get there or more, or you can't buy your computer because the chips aren't being manufactured. So that's an area we're looking at pretty seriously. There's a bunch, but I'll let you guys.
Yeah, interesting. I'll jump in on the first one you mentioned because open banking is it's an area that's pretty close to our heart. Like one of the first things we were able to do as a business win an open banking award, which kind of gave us our seed money to get going. And we're regulated in the EU and in the UK as an ACE, which is kind of like an aggregator under their open banking framework. Canada is in the process of essentially writing legislation, and they've given themselves a loose deadline of end of 2023 to get some framework together. Who knows when it will be delivered, but all of the recommendations that have been put forward speak to a pretty similar framework to what we've seen over in the UK. So, there's a big opportunity for fintechs, intermediaries, aggregators, marketplaces, businesses that are going to essentially to Matan's point, let consumers and businesses mobilize their data. So there shouldn't be any hindrance, any friction, any organizations like banks or any other organizations stopping you from accessing your data and then finding better products as a result of using that data. So banking is one use case. If you look at what Australia are doing, if you look at what Brazil are doing, it's already going into energies and utilities, telcos. There's really no limit as to where we can go with this. Banking just happened to be a really oligopolistic style industry in a lot of countries. In the UK, they started with the 9 biggest banks. They had to open up via APIs to trusted and regulated fintechs, and that allowed users to essentially take their banking data and open up a new bank account if they got better terms. That same use case can be extrapolated and put to broadband, telecom, insurance. It doesn't really matter. Right at its core is data ownership, and that's something I'm really excited about for Canada over the next couple of years, to see, as slow as it might be moving, to see where we end up with version 1 of open banking.
Yeah, I want to add to that because it's a very interesting thing that's happening. Once you start telling people that they can actually own their information, and let's say just in the banking space, and you try to move that information around to different people for different use cases, you start creating whole different sets of needs. Like, how do you deal with KYC requirements, right? How do you deal with identity protection, GDPR? How do you ensure that that people's how do you ensure that people are getting the right products and they're not being taken advantage of? And essentially what that's doing is creating a whole layer of infrastructure and software that's required. I remember I saw this one company, I'm going to speak with them soon, very, very interesting company that's able to basically allow you to do whatever you need for KYC. So you get all the information, including your facial recognition, all that stuff. So you can do everything digital, but it actually masks you digitally. So while the person on the other side of the system can make sure that it's you, it actually masks digitally. So the picture looks the same, but you can't be used for any like machine learning algorithms or facial recognition, some other software or something or other application. Like there's really cool stuff that's being developed now that allows us kind of open system, but also protecting users and making sure that you can move around all this information. It's really cool stuff. Anyways, I'm really excited about it.
It is. There's lots of cool and exciting stuff happening in that space. I'm seeing, so much stuff in the takeout tech space that is changing. I just interviewed Kitchen Hub, and they're talking about a chef who actually made the burger that actually finishes 15 minutes after it's put in the box. It's not ready until, so it's made for delivery. It's not. So these are interesting technologies and stuff that are starting to happen. And I see, I like to joke that COVID killed the fax machine, and, digital signatures and electronic vaults and data are moving huge forwards, and we're seeing leaps in some of these technologies. It's interesting to see what trends other people are looking at. So this is a controversial question, and I've got a few people here to talk to about that. So I'll let whoever wants to jump in on this one. What are the trade-offs of accepting VC funds versus other debt and equity options?
Loaded question.
Should we have the VC go first?
Yeah.
Before we
Right, anyone fire shots?
You go for it. You tell me why they shouldn't take our money. It's great.
Well, I'm not here to speak for or against for VC. There's pros and cons to both. I guess I'll start with the pros that I associate with taking VC capital. You're getting investment from individuals who are in the industry and have expertise in your area, because VCs are the sort of a great example of smart money. They're here because, and they've decided to invest in you because they see the synergy with other investments they're making. They see the value add, and they want to bring the value add to your business. You have experienced investors getting involved and bringing that capital and bringing the know-how, bringing that help, because they see the value add that they can do there. Also, even the exercise of going through a due diligence process with a VC might help some companies kind of get their house in order if their documentation isn't already. We definitely see that with companies and the due diligence that we have to do. It's really sort of forcing them to sort of get all these things organized and prepared before they can take on sort of an external investment. Not necessarily a con, but something to be aware of is, again, I mentioned it earlier, but the VC is not, it's almost never one guy with his own money or girl with their own money deciding to deploy it with no terms and conditions tied to it. Typically, a venture capital firm is working for and based on a mandate laid out with its limited partners. And so if they've gone to the limited partners and they've presented themselves as a VC that's saying, okay, we're going to give you X% return over, typically you're aiming for a 10X return over 5 to 7 years. That's a sort of standardized framework. In that scenario, if you're a business that doesn't fit that model and you're not going to deliver along that timeline, there's going to be a disconnect between what the limited partners are looking for and you. Obviously, there's also additional things to be aware of, that when it's a VC offering you capital, that the VC does have a lot of power in that relationship. And so there's potential for the VC to make use of that power and make sure that they have favorable terms put into the deal in favor of the VC. And if you're looking to maintain full control of your business and not give up any board seats, the likelihood of getting VC funding is also pretty low, because typically if a VC is putting up, $1 million, $2 million, or they're leading around with other VCs, they're going to want, a certain number of board seats so that they can make sure, they can monitor and control a little bit what you do with the money. So you just sort of need to know what really, a VC is not just some magical, fairy godmother throwing money at people. They're individuals. They have, goals and plans, and you need to just make sure that it's a fit with yours.
I don't think that. Yeah, that's true. We are people, I think, some of us at least.
So I didn't mean it in a weird way.
I'm done. I actually, which I agree with basically everything you said. The way I would frame it is like this: don't take venture money if you don't need it. If you can get money some other way, that's great. You should probably do that. When you're ready for a partner, that's when you should go to a venture capital group, because they are going to be a partner. They're going to be, especially in the early stages, they're going to be involved in the later stages. They're going to be involved in your business, and you should want them to be involved in your business. You're bringing them on so that they can give you insight and help and connections and all the things. If you're not ready for a partner, or you don't want a partner, then find some other way to finance your business, and that's probably more preferable, right, for yourself. And it's not going to work out with the VC in any case. But the question I always ask myself when I look at companies, why if they're so great and they have all these other financing options, why are they coming to a venture capital group? It's always like, don't come to ask someone else for their money if you have the money yourself. You have debt options. If you have other options, like even equity, crowdfunding, anything else, like that's almost always better, unless you want a partner. So if you can get debt, then why go get equity, right? You believe in your business, why not keep 100% of the equity for yourself and for your team, right? Unless you really don't believe in it, you want to, diffuse your risk a little bit, right? Then I can understand. So if someone says they really can get $1 million in debt, but they're going after venture money, if the answer is not because they want a partnership, then it's clearly because they want to reduce their own risk, which is a huge red flag.
I think if I was to add something from our side, knowing that we kind of deal with all kinds of SMEs, not just technical startups, sometimes businesses don't understand the scope of where VCs play. And one of the services that we provide businesses is a matching service to VCs and angel groups within the markets that we operate in. So when we actually distill it down and look at our matching engine and look at where the investment thesis lies with most of our VC partners, it falls in a relatively small number of sector verticals, and there's a whole bunch of SMEs on our platform that really wouldn't be a match for VC funding, even if they wanted to. So sometimes we deal with businesses and startups that have a misconception about the types of sectors that VCs actually want to invest in. I think that's the first thing. I think as well, to Madan's point around debt and non-dilutive funding, sometimes that actually is a better option, and it's cheaper if you've got a revenue generating business, or even if you don't, there might be products available to give you leeway for a year as well. But yeah, I mean, it's the other thing that we also help with, and I kind of talk to startups about, is looking ahead to geographies and regions that they're interested in strategically, what type of partnerships they want to strike up. And then trying to identify VCs and angel groups that are strong in those areas and have demonstrated, maybe through their portfolio companies or otherwise, helping startups scale up in certain regions or certain geographies, and be more strategic and sort of thinking long term about it as well as a partnership.
I think you're totally right there, Dara and Matt. And I think because of the interest in getting information about the startup community and the venture space out to the general public, we have sort of accidentally created a sort of environment where a lot of startup founders, not small business founders necessarily, but startup founders in the tech space, really feel like you need VC investment as like a stamp of approval, or it's something to sort of, oh, you're not anybody until a VC has invested in you, kind of a situation, because of, when you look and you see, oh, Crunchbase, this guy got $10 million in 5 minutes and whatever it is. And so, yeah, they feel like they want to have VC investment just because it's the sexy thing at the moment, and not necessarily about what's the right fit for the business. And that's where you really come into the problems, where somebody gets VC investment kind of before they're ready, or when there's not a clear fit between even their goals for the business, how they want to exit, and they've taken a VC investment, and now you're in a situation where the long-term goals between the founder and the VC start to deviate. And that's when you can start really having problems, because the VC is like, look, we invested under this kind of mandate. We are expecting to exit in 5 years with a buyout by a larger company or a PE firm, or going public, whatever it was. And if the founders kind of changed, or there isn't that alignment, then you can really have those kind of boardroom fights, which everyone wants to avoid, because they waste time and money for everybody.
Great points. We've got a couple questions here about, referring to channels and groups for VCs and whatnot on social media. if you're interested and you're actively looking for investment, reach out to any people on the panel here if it's appropriate. But email me, Craig at TorontoStarts.com, CRAIG at TorontoStarts.com. I'll send you some information, our funding scorecard, cold emailing stuff. And, once we understand your funding score and where you are, I'll happily share VC contacts and stuff with you. But I like to make sure we're on the same page. If you're not ready and we're not ready, then, we have investor speed dating. We got pitch school. We got startup pitch battle. We got all coming up this month. So, check out TorontoStarts.com events to help coach you through that. Investor speed dating, you can meet one-on-one with some of the people here and some other investors, and they'll help push you in the right direction. So I've got one more question before some closing remarks. And I'll go around to each of you. One book for every entrepreneur should read before talking to investors.
Before
Alex.
I answer your question,
Okay.
Craig, I'm actually just going to remind people that Swoop Funding is literally like an aggregator system. So
Yeah.
if you're like, how do I find funding? You just go to, he's right here in the presentation. Go to Swoop and they'll say, oh, here's the VCs, here's wherever. If you're looking for like a hidden Facebook group that all the VCs hang out in, that doesn't exist. It's just the individual VC. You need to find the VC that you feel like applying to, but before you apply, read their Twitter or whatever and make sure you're not going to do a faux pas. One book that I recommend everybody read is Venture Deals by Brad Feld. I say this every time you ask me, Craig.
Yeah,
it's very helpful. It's written by some famous VCs about the sort of startup funding VC capital raising landscape, and really emphasizes and helps founders understand what VCs do, how they operate, what they're looking for, all that sort of stuff, so that you can be properly prepared to have a realistic conversation with Yumatan when you meet him, instead of just saying, my startup has no revenue and is worth $500 million. So give me all your money, VC.
All right. Good points. And I think you're right about the no real good social media list that has all the VCs on it. But, people are looking for the shortcut, and what they're looking for. I've got, I'll tell tales out of school here. I got a list with over 10,000 investors on it. And that's what people want. But you don't get that unless I think you're ready to talk to investors, because I don't want you wasting anybody's time. So you got to prove to me that you're ready or you're close to ready. Then I'm happy to share that information, because nobody wants spamming. I don't want that happening. So that kind of stuff. So email me on that. Yumatan, best book entrepreneurs should read before talking to investors.
I wouldn't say so just before talking to investors. There's a great book called From Good to Great, and really talks about how companies, last long and what they do, and how they really set up their own businesses and mindset to succeed. Really recommend that book. And one thing that I've noticed is that there's so many resources out there. Alex is one resource, and Dara, and obviously you, Craig, as well. If you have something unique that you're bringing to the market, it's almost, with all the incubators, accelerators, grants, and support, you'll find the support, you'll find the money. You have to have a little bit of gumption, you have to have a little bit of sacrifice, maybe not take a salary for a little bit before you get things going, but you will find the right support. That's our entire ecosystem has grown by many, many, many times in the last few years. So I wish you guys the best of luck. And Craig, feel free to share my email with anybody that wants, even just for advice or something.
Fantastic. And Good to Great was the hedgehog concept, if I remember correctly. I haven't read it for a few years, but good book. Dara.
Yeah, this one is not a new one. I only just read it last year for the first time because it was recommended to me by a VC. But it's called High Output Management by Andrew Grove. So it focuses on Intel, and it's more just kind of analogies around building up a company as opposed to preparing to go in front of a VC. So I know it's not answering your question directly, but it was the first book that came to mind.
And it's one I haven't read, so I'll put it on my list. Thanks for that. And if people want to find out more, this has been great. And your knowledge has been fantastic, and each of you or companies do different things. So I'm going to leave you with parting words. And if people want to find out more, where do they go? We'll start with you, Alex.
They want to find out more, they can go to our website, equivesto.com, EQUIVESTO.com. We have tons of information. We have an entire learning center, community pages, hundreds of hours of free content about not just equity crowdfunding, but the entire funding landscape in Canada.
Fantastic. And Matan?
Go to our website, verstraventures.com. And yeah, all our information is there. You can reach out to us through that. Or just Google my name and find me on LinkedIn or anywhere else.
Fabulous. And Dara?
Yeah, so you'll find us at swoopfunding.com. We're reasonably active on all social channels as well, so you'll see us on social media, and hopefully we can be a tool to find the right funding solution for your business and get you connected with partners like Alex over at Equivesto as well.
Yeah, we're somewhere on Swoop. I don't know. We're hidden in the bowels of Swoop someplace.
Yeah, there is a ton of funding information on there. Everyone should check it out just because, again, you're probably leaving money on the table. So talk to somebody there. Thank you so much for spending the time and sharing your expertise with our audience. I really appreciate it. And I'll be talking to you all very soon. Thanks again.
Thank you.
Thanks, everyone.
Thanks, guys.